Okay, we're going to start today by looking at the calendar. Right now, we're approaching one of the traditionally best weeks of the year. It's the Thanksgiving holiday. Everyone is excited about the holiday. We're going into another holiday coming at Christmas and then at New Year's. So three big holidays in a row. We expect a really good week this week, and we're pretty much overbought in the stock market. We've been overbought for a while. You can see that we're above all of the moving averages, the 50-day moving average, the 100-day, the 150-day moving average, and the 200-day. So you can see we're basically levitating over the 50-day moving average, which is the purple line here. So it looks like we have a lot of momentum in the stock market. And a lot of people are greedy right now. Everyone knows that this is a good time of the year. And we have a new administration coming in. There's a lot of optimism. So we're going to watch this line, this 50-day moving average for the S&P as support. The most important one to watch is this black line, which is the 150-day moving average. So if we have some kind of pullback in the stock market, most likely we're going to pull down to this level here. And that's going to be our floor for for our expectations if we continue in this uptrend. So far, the uptrend has been pretty reliable. As you can see, going back almost 2 years now, we have this trend line that has uh, been support for the S&P, and almost every stock in the stock market follows the S&P in a way. So you can see this 150-day moving average, which is the green line in this diagram. You can see that it has been support for the past 2 years. And that's why we're watching that line as the bottom line of this trend line. So it looks like, if you're an investor and you have some money already invested, it looks like it's um, lock and load time, which is you basically, um, hopefully you're at a point where you're fully invested in just watching it levitate up. We have a lot of things we're monitoring for potential stock market crash or correction activities. We'll go over those later, but right now we have the 10-year and the 2 year. Let's look at the 10-year and the 2 year. They're basically the S&P is going up, and the 2 year, the 2 year and the 10-year are going up with the 10-year, which is quite opposite what it's been doing for the past couple of years. It was opposite. It was an inverse correlation up until October 5th around, and then we're doing mark time with the 2 year and the 10-year with the S&P 500. So it seems like good news for um, the stock market is good news for the yields for the 10-year. Let's look at more of our talking points here. We have another Fed meeting coming up in the middle of December. We had NVIDIA earnings in the past week. They were very good. And um, now we have appointed digestion time, you can call it, in Thanksgiving week. So we have a lot of earnings reports that are already over. We don't have earnings again until February or January. January is the time when we have earnings reports starting for the banks, and then we have February. That's whenever the big tech earnings come out. So we have a lot of good feelings in the market in the coming months. So usually, I'd say 90% of the time, the stock market is positive for November, December, and parts of January. All right, and we have earnings, of course, coming out in January. That really helps the stock market get excited. So let's look at some more things that we're thinking about here. We have our seasonality. We always like to check this every week. November is actually one of the best, it's actually the second best month seasonality wise in the stock market. And December is one of the best months. So we have two really 3 good really months together, 4 months together that are really good. So it's always good to remember seasonality, but it's not perfect. It doesn't work all the time. All right, so for the stock market, for the S&P, we are still overbought. We've been overbought since the election, basically, and there's a lot of optimism for deregulation, for companies to be more efficient, and for improvement in government efficiency. So we're above all of the moving averages, and that's usually a bullish sign that people are excited and the stocks will continue to go up. So let's look at we already saw this. The 2-year and the 2-year and the 10-year both are going up, and the stock market and the S&P is going up with it. So um, right now for the major variables in the stock market, we have oil going up around 7% this week. And we don't know, there's no real good reason why oil goes up or down. There's supply and demand. There is um, the economies of the world that are improving. If they're improving, then the price of oil goes up. But if the supply of oil in the world goes down, then the price of oil goes down. I mean, the price of oil goes up. So those two, we don't know which is affecting the price of oil in any given day. It's just one of the variables that we deal with on a regular basis. But it's one of the most important for stocks because it affects the price of every stock that we monitor, every product that is delivered by companies around the world, because there's delivery costs, and that you deliver things using oil, and there's plastic uses oil to for a product for a ingredient. So there's a lot of reasons why oil is very important for understanding the stock market and investing. Inflation isn't changing a whole lot. We have the dollar going up, actually. Maybe the dollar is going up because it's anticipating a really good economy for the United States. Gold is up 5% this week. And let's see, we have a formula. A stronger US dollar tends to drive gold prices lower. So we've been having a stronger dollar, but the gold price didn't go lower. It went up this week. So that correlation didn't work. All right, so we have dollar index. Look at this. The dollar since the election, we basically had like the dollar jump quite a bit. So we're in this uptrend for the dollar. And that'll have a lot of ramifications on the stocks we're following, especially multinationals. So we'll keep our eye on this dollar. If it keeps on appreciating, that could hurt some of the multinational stocks, such as Google, Apple, that sell overseas. Okay, fear and greed index. We are greedy. So you can see from our stochastics charts that there's greed. We are above all the moving averages, and people are excited right now. So we don't have any major issues looming that could cause a stock market crash, other than perhaps the debt of the United States. But right now, people are pretty excited, and that kind of echoes that there are more bulls than bears in the amateur investment survey. And the VIX is tanking this week. It went down 10% on Friday. So you can see that it's pretty much at a yearly low, meaning people are not buying protection, they're not afraid, and they are pretty excited about buying in the stock market. So right now it's at 15, which is really low. Okay, so if I look at the front page, this is our emotional chart. And we have several phases of the stock market and investor emotions. You start off by like getting some enthusiasm in the stock market, then you get greedy, like we are right now. You get delusional, and we see the price of like Bitcoin going up, which is as speculative as you can get. And we have a lot of excitement. So we're about right here in the emotional graph. Um, it isn't until we have capitulation where we have fear going into the market and we see a lot of bargains in stocks. We're not there right now. We're basically at a delusional state. So don't get over your skis right now because just it's just whenever everyone's buying and everyone's getting excited, you got to do either the opposite or don't buy, because you might get yourself into trouble. Because just whenever everyone's selling, you don't want to be the person selling after you bought at the top. All right, so let's look at some of the issues that may cause a crash in the stock market. Okay, we have the Republicans winning the majority in the House in the Senate. So in other words, right now something that could we have a situation where the Republicans took control of Congress, which means there's going to be a lot of bills passed, and that could affect the profitability of companies. We don't know if it's good or bad. And in the past, bipartisan Congress has led to stalemates and no laws being passed. And if that happens, then that's usually good for stocks. But we do have a potential of there being laws passed that affects some of the stocks we're following. Um, and we'll watch out for anything that could happen there. We still have a problem with the debt of the United States. We might have some efficiency coming in to the new administration might help out by reducing some of the expenditures. I don't know, but that is an ongoing issue that I'm worried about. Um, AI stock bubble. It doesn't seem like it's bursting. We have Supermicro. We'll go over Supermicro a little bit later. It's a stock that's an AI darling. It's the third greatest purchaser of chips from NVIDIA, and it has a threat of being delisted. So that could like cause a crash in the stock market if some of this is unwound and other things happen because of that. Um, NVIDIA had earnings and they said it'll be great. Their outlook is great. They said they beat and raised their forecasts, which is usually good, but there was a lot of expectations. So we don't have an unwind of the AI stock situation. It looks like it's still going good. Um, okay, we still have an issue where Trump is going to be making some comments on a regular basis, which will affect the stocks going up and down. Some of his appointments already are affecting the stock market. So we have to be ready for a bunch of years of randomness. And part of investing is you got to invest through the ups and the downs. So we're going to be ready for that. All right, so let's look at some more of our comments. Okay, so we always follow this worst to first. Um, right now, the best from last year, you can see the best from last year and the worst from last year. It's we're seeing this week, believe it or not, financials have turned into the best sector of this year. So as one of the worst of last year, financials only 9% last year. It's basically got 34% this year. So that's higher than the information technology sector and communication sector. We have the utility sector is up 28%, which is not that bad. So so next year we're going to do the same thing. It looks like energy is going to be a sector that is on our list for first to worst. So we had energy negative 5% last year, and it's one of the worst sectors this year, only at 15%. There's a good chance there's a great demand for energy stocks because of a possible booming economy in the coming years. So We're going to have our first to worst. Our energy is going to be our first to worst for next year. And let me see. All right, so, okay, let's look at our next slides here. Okay, we're going to look at some of the sectors going up and down. Okay, the sectors. Okay, so let's look at the 10-year. Okay, 10-year, you can see it's been going up, but lately on Friday it was down 2.02, which is a lot. So if it's interest rates for the 10-year or down, let's look at our cheat sheet. Yields of the 10-year going down. That's positive for small caps, high yielding stocks, home builders, speculative, and REITs. And that's negative for large cap financial sectors, banks, insurance companies, brokerage firms, and insurers. So let's see if we can see that correlation here. Okay, so we'll add, okay. Okay, so we have for the best regional banking. So interest rates are going down, and that's positive for, we thought it would be positive for negative for banks, but it was positive for banks today. In general, the banks are one of the sectors that are going to be helped by deregulation. So there's going to be a theme of deregulation throughout the coming year, and they're going to benefit the most. So maybe there's excitement in the air for banking stocks right now. Telecom, let's see, negative. Okay, we have the 10-year is down. So let's see if the yield's going down, that's positive for high yielding stocks. So we expect a lot of high yielding stocks to be doing good. And that's telecom is one of those high yielding stocks. We see as interest rates go down, that helps the home construction because that makes houses more affordable. And we have biotech that there helped because as interest rates go down, that helps them borrow money to do their um, investing. And okay, so that made sense. That so far that made sense. We have in our top holdings, we have the stocks that are yielding a lot and that are very sensitive to interest rates, such as banks and utilities. Let's look, where are the utilities here today? Utilities are actually down a little bit. I would expect them to be up due to the interest rates, but they're down today. We have semiconductors down. So yields of the 10-year going down, negative for large cap tech stocks. Okay. All right. So we have that correlation again today, which is very useful. Now let's go to the market movers, the ones going up and down the most. Okay, what we're going to, you can see that the best performing stock is Supermicro right now. We're going to go over Supermicro a little bit later. This stock is one of the AI darlings. They work hand in hand with NVIDIA to build out data centers, build servers for the data centers. And they had a little bit of a problem with stating their accounting, and they're getting that fixed up right now. So they're basically, it's almost a lottery play for them because they have like a 50% chance of surviving and avoiding delisting, or if they get their accounting in line, then they'll survive and they'll grow and they'll be 5 times more valuable than they are right now. So that right now, Supermicro is 5 times undervalued, and people are um, on the fence whether they'll survive or not. So let's look at some more of the stocks going up and down. We see Moderna. They're a stock that they're a company that makes vaccines, and they were totally affected by the choice of Kennedy as a advisor for the next administration, which may or may not happen. So we see there's like could be a dead cat bounce, or it could be people just saying that's not going to happen, and there's still going to be a demand for vaccines. We have GM, we have Tapestry. Okay, I don't see any real theme here. Palantir Technologies. Okay, they're AI. You have CrowdStrike, which is a cybersecurity. So, and Supermicro is an AI company. So we have a couple AI companies in the top 10. Let's look at the top decliners. Intuit. Okay, this is an example how just one news story could affect um, a stock. We have Elon Musk as part of his efficiency program for the government. He said one of the first things he's going to do is introduce a free tax filing program. And that totally affected Intuit, which makes their money off of selling software for tax submission. So we have NVIDIA. That could have been because of buying a rumor, selling the news. Um, there are people there. NVIDIA went down whenever the stock released their earnings because there was a lot of expectations. But in general, NVIDIA really did good on the report, and they're still growing. So there's just a lot of noise right now, but in general, NVIDIA is still going up. We'll go over that later today. And let's look at other things that are going up and down. Okay, Vistra Corp, they do servers for, they work with the AI infrastructure to build out infrastructure for data centers. So we have a lot of AI companies in the top decliners too. Okay, that was a good little exercise. Let's go into Dan Now's picks from the beginning of the year. Amazon up 29%, Meta up 59%, Texas Instruments it's up 32%, XBI 13, and KWeb is 27%. So this is an example of Dan basically at the beginning of the year being contrarian on a couple of stocks. This Texas Instruments was down several years in a row, and he said, well, it's bound to be good after several years of underperformance. And the same thing with XBI. He said, well, the sector has been out of favor for quite a while, and it's about time for them to. This is the biotech small companies ETF, and KWeb is of course the Chinese companies, the tech companies for the Chinese sector, and it's up 27%, and it's still one of the most undervalued sectors in the stock market, but it's really hard to invest in Chinese companies because the price realization may never happen because um, there's just a problem investing with China where there's an geopolitical risks, and we don't understand that well enough. Most people cannot really take that, understand all the risks involved. All right, so we'll look forward to his picks next year. I picked out a couple interesting charts to look at. The first chart we're going to look at is the gold chart. About 2 weeks ago, we saw the gold basically hit the bottom of the channel and it was oversold. And you can see it's starting to bounce. It's like halfway between the channel lines. So, the stochastics are low and they're going up. So that was a good little exercise we had there. Let's look at another chart here. We have XLE. We noted like right around here a couple weeks ago that we were seeing a breakout. We're seeing one of the most underperforming sectors going back a year. It was in a downtrend, and you can see that we're just we just started this uptrend here. So this right now we're overbought, in the stochastics, we're overbought here. But if we start doing this zigzag up here, up right here, maybe here is our next spot, and we start going like this could be the next best performer in the stock market. We have a lot of catalysts. We have the Trump administration signaling by all of his picks for the cabinets that he's going to be energy friendly. So there's going to be a lot of deregulation. The oil drillers in America are going to be pumping an amazing amount of oil and they'll be profitable. The only downside to that is if you pump a lot of oil, the price of oil goes down, so you're not as profitable. So there's a balance there, but I think this sector could be the next um, high performing sector for the next year. Let's look at Alphabet. You can see that Alphabet took a hit this week. It went down like 5% one day. The Department of Justice said that they would try to break up Google and take Chrome into its own company. So that would really affect Google because that would affect their growth rate. I think if that actually happened, it would mean maybe a 10 or 20% hit in the stock price because they might lose some market share. Right now, Google Chrome has the ability to direct people to the Google search engine when you type it into the address bar. So that having that as possible, allowing other companies to do that, they might lose their 90% market share, maybe down to 80%, and that could reduce their 14% growth rate down to maybe 10%. So we don't know what's going to happen there, but in general, it's going to take 3 to 5 years for all that to happen. So while that's happening, Google is still growing at 14%. So right now, I'm still holding my position, and you can see it's still on this channel going up in a like a 14% growth over time. So until it breaks this channel here and starts a downward trend, it seems like we're still in an upward trajectory, and we're going towards the better part of the year. So we're still okay with Google. I'm going to go over Google a little bit later on today. But the greatest bubble in human history is close to bursting. And there's this guy comes on like maybe once or twice a year in an article, and he makes this statement like this because he makes his money um, in a fund that does extremely well when there's a crash. But other than that, if it doesn't crash, then then this is like a super losing investment. But he has some theories, and his biggest concern is the U.S. debt. So the government's 34 trillion debt would make it more difficult for the Federal Reserve to revive the economy if there is a recession. So he has a really big concern about the debt, and he thinks this is a mega tinderbox time bomb. So he's been warning since January of last year. So a broken clock is right twice a day. So what they're saying here is, there are people that predict recessions and they never come about. And this guy, you know, you have to keep this in mind in the back of your mind. There's this a problem that may happen. We've been talking about the debt for every day for the past couple of years. The $34 trillion debt is a very big risk to investing right now. But we do have some new people in the government that might help reduce that debt, and that could be a catalyst to having this go away, this problem. But it may happen, so we'll keep it in mind. Um, okay, so NVIDIA had their earnings this week, and the price target were over have been increased for NVIDIA. So what I thought would be interesting to do is go through NVIDIA's earnings just to see if the estimates have changed since the last time we looked at it. Um, from this year to next year, earnings are expected to be 126% greater. So if you divide these 2 years, next year from this year, 294 divided by 1.30, you get 120%, 126% increase. So we expect the PE to be 126 if it continues to grow at that rate. But the PE right now is 33 and it's growing around, let's say 48%, just to be conservative. If you divide all these years out, they're growing around 48%. So their PEG ratio is 0.68. So they're around 32% undervalued according to the current statistics. And you can see a great growth stock. You have a line going up. Look at these. Look at these bars. These bars are in a straight line and very consistent. And you can see that we're overextended in the price right now. A lot of times the best time to buy a stock is whenever the charts are going up for the earnings estimates and the stock is down here. It just corrects like super micro. We'll go over super micro a little bit today. So let's look at the NVIDIA statistics after the earnings. You can see they have they're the largest company in the country right now. We have a forward PE of 33, and the PEG ratio is 0.89. So Yahoo agrees that it's undervalued by 11%. Okay, so their profit margin is an amazing 55%. That's 5 times what we're looking for. And return on equity is 123%. That's greater than the 14% that we look for. And they have more cash than debt. So they don't have a problem with debt. So this is a really high quality company that's growing um, growing around 30% or 40%. So let's look at so it looks like earnings estimates are going up. It'll take a while for them to show up on our E-Trade earnings estimates. We'll check in with that later on. Okay, so there's another article. Justice Department calls for breakup of Google and sale of Chrome. So that really affected Google stock. Google went down like 5% that day. And we don't know if this will ever happen, number one. Number two, there's going to be appeals filed, and this will take like 5 years to actually happen if it happens. In the meanwhile, Google's going to be growing 14% a year until that happens. And so I guess this could be like a sign that we should, if you're super heavy invested in Google like I am, it might be wise to start selling a little bit just in case they lose their um, advantage in the stock market. So if this isn't just the first thing that could happen to Google. They could not only divest a lot of what they have right now, they might force them to spin off a lot of the other assets like Android. Just think of what they could do to disable this company. So they're being picked on right now, and it's not fair, but it's going to hurt the company if this happens. So we have to really consider if that's going to affect the earnings estimates. We're going to look at the earnings estimates now just to see if they're changing. Okay, so we can see that they're still growing around 13%. If you divide the years, if you divide not 8.94 by 8.02, you get 11%, 13%. So I'm thinking they're growing at 13% consistently. You can see their growth chart is up in a straight line, just like NVIDIA. So that's a sign of an excellent growth stock for buy and hold. But you can see that they're starting to, their stock price is starting to go down. And That's like whenever its stock goes down and their earnings estimates continue to go up, that's a good time to start looking at it. But their PEG ratio is around 1.38, so they're 38% overvalued right now because their forward PE is 18 and they're growing at 13. So if they were at fair value, they'd be growing at 18% at a PE of 18. So they're overvalued right now. So there's at least 30, they could drop 38% and maybe down to $120 a share, and then they would be fairly valued. All right, let's look at some of the statistics in Google. We have a $2 trillion market cap. The forward PE is 18. The PEG ratio is 1, according to Yahoo Finance. So Yahoo thinks they're growing at 18%, and they're totally fairly valued. Their profit margin is an amazing 27%. That's double what we're looking for. And return on equity is 32. That's triple what we're looking for. And they have more cash than debt. They have like net $70 billion in cash, which is really good. And that would actually affect their PE ratio. So they'd have a 14 PE if you factor in the cash. So let's look at some more things. Okay, so we're gonna look at Supermicro. This is a company we highlighted like a couple weeks ago. They had a problem with their accounting where they didn't submit their forms on time for the government, and there was a short seller saying that they didn't do their accounting right. So right now their valuation is like super attractive, but you have a possibility of them going out of being delisted. So they have a forward PE of 6, and it's stunningly cheap stock. We're going to go over the statistics on this. The one problem they have is their accounting. Um, they're getting an auditor to verify their accounting, and that auditor, whenever they do submit their their revised forms, if that passes, there's a very good chance this stock will like explode and go up 5%, 5 times where they're at. So we're gonna look at their statistics and see where they're at right now. You can see their outline from this year to next year. They're growing around 44%, 26, and 13. So I'm saying right now, let's say if they're growing around 44%. Their PE ratio is 10, so their PEG ratio is 0.2, so they're 5 times undervalued. The only issue is they could be delisted, and then they'd be worth nothing. So we don't know what's going to happen there. But let's look at some more things. Their enterprise value is 20 billion. Their trailing PE is 15, and their forward PE is 10. So, and their profit margin is pretty decent. It's 8. We like to have a stock with 14, or around 13 or 14. The return on equity is good at 32. That's 3 times what we're looking for. And they have more cash. Let me see. They have more, no, they have about equal amounts of cash and debt. So they don't have a problem with that right now. So that was interesting to go through that. This kind of stock is definitely a contrarian play, but this stock, you have like let's say a 50-50 chance of this being delisted. But if it does survive and it does pass its audits, this could be one of a very high growth company. You can see their earnings estimates haven't changed and they're going up. And they're in AI. They build machines for data centers, and they're working with NVIDIA, who is growing at 40% or greater. So it's a very risky situation, but for a small amount of money, that can turn into a lot if it passes all the accounting irregularity problems. Okay, let's look at the next thing. Okay, we did a Fidelity screen for this week, and I sorted by market cap. So let's review the screen that I make every week. Hold on. There it is right here. Okay, so what I do in the screen is I look for companies with very low debt. We have a return on equity greater than or equal to 12, a profit margin greater than or equal to 12, market cap greater than 50 billion, because higher market cap companies are more reliable with their earnings and their accounting. The forward PE, we like to have it low compared to the growth rate. So if their forward PE is 10 and they're growing at 20%, then they're half off. We like the growth rate greater than or equal to 10, and the PEG ratio, we try to buy them around 1 or less. But you have to pay more for a company that has that is a better quality company, usually. And you can see one of the qualifications, see this red line here, we like to have these earnings bars go up in a straight line like that. And we've been seeing that in Google, we've been seeing it in Supermicro and in NVIDIA this week, for instance. So this is the formula that I use for investing. Now let's look at, hold on, I want to go back to our screen. There it is right here. So I did that screen. I do that screen every week, and I noticed a lot of financials in our screen. Financials are on fire right now. They're going to be helped by deregulation. I see financials and oil companies in our best in our screen. So I thought that would be something to focus on. We have new holdings. They do oil drilling. We have Energy Transfer. They do pipes for the um, transfer of oil and gas. We have Square. They're a financial company. You can see all the ones that I highlighted are undervalued. Their PEG ratio is less than 1. And we have Baker Hughes. They are a basically half off according to this. So they have 0.58 PEG ratio, and they do drilling for oil and gas companies. Okay, so we have a lot of oil and gas and financials still undervalued. And so that could be another indication that those sectors will be ones we choose for next year's best performers. So what other sectors are in this screen? We see a lot of Chinese stocks. Look at this, JD.com. We see EDD right here. These are Chinese stocks with 1/3. Look at that PEG ratio of 0.3. So they're truly a contrarian play right now. And you have to have a lot of guts to be a contrarian, but usually when it's contrarian, when you're contrarian, you're doing things the market isn't anticipating, and that's sometimes the times to buy the best at the best prices. And we also have some more financial here. These are companies that invest in startups, Apollo Management. We have KKR. So we have a lot of financial companies that that are in this screen. So it's always good to look at the screen to see if there's any sectors that are combined or out of favor. Those are the times that you start looking at individual stocks to see if you can start dollar costing into those sectors. All right. So we're gonna keep this is gonna be something we review on a regular basis. You know, the winners in a new Trump presidency, just think of the word deregulation and how that could help sectors. Right now we have the energy sector will produce more oil. That'll help inflation go down, and it'll help the profitability of the oil companies. So let's keep our eyes on that energy sector. We have real estate sector. I think Trump wants the interest rates to go down, so that could help the real estate. And of course, financials. They're in our top. Um, they're all over our screen for best valuation for companies. So, and also they're going to be clear winner when there's less regulation. They're going to basically right now what happens is banks have to put a lot of money aside for um, just for covering things if things go bad. And there's a lot of things that they have to do to, they spend billions in doing things that may not be necessary, such as um, filing forms that aren't really needed to be filed. So they're going to be deregulating and that making it more profitable for banks. And utilities, that might help. We have two things going on. We have the AI infrastructure build out, which will help utilities, and deregulation may help them increase their prices on their energy. So that is what I had to say for today. I hope you enjoyed that. And if you have any questions, let me know and I'll go over it next time. And have a good next week of investing.